So I'm going to try something different in this video. I'm going to do a review of current ratio. So we'll talk about a ratio. And I like semiconductor companies. There's a lot of big ones out there. So it's a good kind of industry to kind of do stuff like this with. This is every semiconductor that trades in the U.S. And we'll list their current assets, current liabilities, and calculate the current ratio. And I downloaded all their 10Qs. Well, not Taiwan Semiconductor because they're not an American company. So, but I do have their financials to calculate the ratio. I pulled it from their website. And just to give you an overview of what current ratio is, you probably know it. It's a pretty common formula, but some people may not know it or forgot. It just compares a company's. This is almost exactly from Investopedia, but I kind of changed some of the wording to make it sound more user-friendly. But I personally use Investopedia all the time, and I think I learn more from Investopedia than I did all my undergrad and grad school. It's just very user-friendly, very easy to read. If you want to, when I was really digging through, like 20 years ago, when I was really trying to learn how to read through financial statements, I would go to like websites like Investopedia or similar sites. I was like, what does this term mean? And it just took years and years and years before I could understand everything. But if I ever hit a term that I didn't understand what it meant, like a word in the financials, I would just Google it and read about it. So that's pretty much. I still do it. Like sometimes I'm looking at foreign financial statements, and there's some terms I'm just not used to. So, anyways, the current ratio compares a company's current assets to its current liabilities. That's the formula: current assets over current liabilities. In case you don't know how current assets are defined, they're assets that can be turned into cash in a year or less. So highly liquid assets. And we'll go through their financial statements so you'll see exactly how to do it and exactly what the current assets are. I'm sure you know what the current assets are, or at least some of them. Current liabilities are liabilities that would be paid in 1 year or less. So like accounts payable, it's a current liability. So it helps investors understand more about a company's ability to cover its short-term debt. Because if a company has a current ratio below 1, in theory, they cannot cover their short-term liabilities. That doesn't mean they're going to go bankrupt within a year. They need to generate cash flow from their day-to-day business in order to cover that gap. And like I think companies like Coca-Cola always have current ratios below 1, but it doesn't really matter because they have so much cash flow coming in. Hello. Can anybody nobody's commenting. I'm getting concerned that people can't hear me. Leave a comment. Just make sure. Just tell me you can hear me. It's like doing these videos, you get paranoid about things like that. But anyways, yes, just say something. Okay, thanks. Okay. In 5 minutes, I'll go through their financials. So this is the boring part. Thank you, Ibrahim. I think I'm saying that right. I always try to say, I don't know if you watch my videos, I always try to say everywhere correctly, like how to pronounce foreign currencies or people's names. Sometimes I have to Google it. Okay. And it's nice because it's ratios like PE, price sales, ROE. It gives apples to apples comparison, because how do you really compare Nvidia to Micron? I mean, Nvidia is like 20 times the size. So you can't say, okay, Nvidia has X revenue, therefore they're better. No, you can't. Of course, they're gonna have more revenue than a Micron, but you use ratios like current ratio. Okay, but there's flaws. You can't really, comparing it industry to industry may not make the most sense, because some industries carry really low current ratios because they don't need to have much cash, because like a company like Coca-Cola, every day they have $1 billion coming in of cash. Like, there's so much cash coming in. Or a Microsoft or an Apple, there's so much cash coming in every day, so much sales. So they don't need to have a great current ratio. They probably do, most of those companies. But certain companies, especially startups, especially companies that don't have positive operating cash flow, if they have current ratio below 1, big red flag. But you usually don't notice these red flags until it's too late. But if you can identify the red flags before others do, and then you can either short the stock or long it. Another weakness that I don't see many people talk about, but I think it's a weakness, is that some current assets are better than others. So if like two companies had a current ratio of 1.5, that indicates they could both cover their current liabilities with their current assets 1.5 times. But what if one of the companies has all cash, all their current assets are cash? The other company has inventory, all their current assets are inventory. Well, inventory can't cover your debts. You have to sell your inventory, and sometimes it's not easy to sell inventory. It's doable, but it's not easy. Cash is the definition of liquid, so you can you don't have to convert it to anything. It's already in its most liquid form. Okay, so now that's the boring stuff. So let's go through. Let's do Nvidia first. Nvidia. I'm working on my Suncor video now. I always search current assets when I look at these. Not even if I don't want to look at the balance sheet, because sometimes it's hard to find where the financials are. This happens to be in the beginning, but sometimes in the middle of the document. But current assets, I just search because it doesn't pop up too much. Like if you search cash, you're going to have like 200 hits. But current assets is kind of a unique term. But anyways, in this case, it works out because that's what we're looking for. So let's, and it does change over time. It's really user-friendly. They give it to you. They even write it out nicely. Not every company makes things so user-friendly. Current assets, current liabilities are pretty easy to find, but some things aren't that easy to find, and some things, the naming convention changes. And especially if you're new to reading financials, you could get confusing. Even something as simple as the income statement. Like this is called the condensed consolidated statements of income. So it's the income statement. It's kind of switched around. So it's kind of obvious. It's the income statement, but sometimes they don't even use the word income statement. So it could be a little confusing, like when you try to search these. And that's a pretty simple one because it's very easy to identify the income statement because revenue is on top, net income is on the bottom. But of course, it's easy for me, but if you're new to it, it might not be so easy. But anyways, let's just calculate the current ratio. And this is a good exercise to do if you want to learn about an industry, or if you want to invest in a certain company and compare it. And it might take you, it's like changing a tire. The first time you change it, hours. The second time it still takes hours. The 20th time could take you 20 minutes. It just once you do it enough, you just get used to it and you start learning all the nuances. So let's just list it out. You don't have to spend so much time on things, but in the beginning it's good to do this, because then you learn really well and it makes more sense. But now when I do it, I could just look at it and I see current assets, current liabilities. I get a sense for where it is. But let's cash 5519, and all these are in millions. And you should make sure, because I know it's in millions, but some are in thousands. Let's I always a stickler of formatting. I like consistent formatting. Okay, 5519. That's the cash. Marketable securities. 12762. Accounts receivables. I would usually put AR, but I'll just spell it out. Accounts receivables 8309. Inventory. You see, it goes down from most liquid to least liquid. Cash is the most liquid, so it's on top. The least liquid is prepaid expenses. So inventory is much less liquid than cash and accounts receivables. Because accounts receivables, you already used your inventory, you already sold the product. Now someone owes you the money, you just have to wait for them to pay you. And it's pretty likely you're going to get paid. It's probably 95% of the time you get paid. There's times you don't get paid. People return products. People go out of business. But generally you get paid. Inventory, you have to do something with that inventory, find a customer to buy it. So that's why it's lower on the liquidity scale. And then we can see the actual current assets, the actual current liabilities, and compare it and see if they're really apples to apples. Prepaid expenses 1289. So 32658. Okay, I just want to double check I did entering my numbers incorrectly. Let's do the current liabilities. Accounts payable 2380. Accrued liabilities. And I've looked up every term at least once, some terms many times. Let me know what you think, if this is helpful. 9101. So it's 3.6, which is a really good current ratio. They can cover their current liabilities 3.6 times. So it's like more than 3.5 times. So even if they had a mostly inventory or mostly prepaid expenses, it's still fine. They have so much of a cushion. If you wanted to like make it more strict, you can look at just their cash. Does their cash cover their current liabilities? And it does. Well, marketable securities is pretty much cash. And if you're not sure, you should look up these terms. That's how I learned this stuff. I've looked up every term at least once, because I always like, what is that marketable securities? What does that mean? I'm like, so just Google search it, and then I could see 12762. 5 billion of that is corporate debt. 5 billion is U.S. Treasuries, which is cash. 2 billion is U.S. debt, U.S. government debt. Then you have CDs. I mean, this is pretty much almost cash. It's very easy to convert this into cash. That's why it's so high. It's like a stock. A stock is cash. I mean, you can really, as long as the market's open, you can convert it to cash at any time. Stocks fluctuate, of course, but at any given moment, you can sell the stock and convert it to cash. That doesn't mean you're going to make money on a stock, but it's very easy to convert it to cash. Real estate is not easy. Real estate, I mean, at least probably a month to convert it to cash, even if you found a buyer today. A cash buyer, even if you found a cash buyer today, it could still take a week or two. And that's if you got the perfect scenario. But most of the time, it's not the perfect scenario. You have to find someone and have to be able to fund it. But it's good to like know what this stuff is. Is this good or is this kind of boring? I feel like I never get a lot of viewers on any of my videos. I think I'm just really boring. But I can't really do anything about that. Accounts receivables. If you want to, I don't know if they list that out. They might. No, they don't. That's just how much is owed to them. I was hoping they might list out which companies, but inventory, they might have some detail on this. Yeah. So they're a manufacturing company, so they have inventory in 3 buckets. They have raw materials, the very basic, the beginning inventory, work in process, the second stage of inventory, and finished goods, the third stage. So if it's in this third stage, it's closer to cash. If it's raw material, it's further away from cash. It has to move through the manufacturing process. And then, of course, you have to sell it. But the raw materials, you can't even do anything with it yet until they move it through the manufacturing process. But generally, Nvidia, you wouldn't really, current ratio doesn't matter too much. Current ratio is really important if you're looking at a company that's not making money, that's still growing. If they have a current ratio below 1, that's a big concern. You want to, sometimes a company that is just starting out has a really high current ratio, like a 10 current ratio, a 15 current ratio, because they need a lot of cash to fund their growth over the next few years. Because most companies could take several years to start generating positive cash flow. But this gives us an idea of how well funded Nvidia is, which we pretty much knew. But now we have that confirmation. Taiwan Semiconductor. They don't have a 10Q, but I did find this on their website. It's just a list of their financials. So it does give what we need. And it's nice that they convert to US dollars so we don't have to do the conversion. And even if you know, like, even if you're like, oh, I know what current ratio is, I don't need to go through this exercise. You're going to learn a lot more if you do these, if you spend time. Because you're gonna you learn things. You what I just did, I searched the financials Well, maybe you didn't realize. Wow, they do have a lot of cash. I didn't realize, actually. Mike, what's up? Spicy, thanks for commenting. It lessens my anxiety when I see comments. I know people are listening, but it gives that confirmation. I appreciate that. Mike's always makes a lot of funny comments. Been around for a few years, so I appreciate that. So, Taiwan Semiconductor. This is the largest foundry in the world, semiconductor. 4637, ton of cash. Investments in marketable securities. I think that's the same. You can say it's marketable securities. It's pretty much the same thing. But if you're not sure, you can just create a new line. Please share the links to tools you use, like Simply Wall Street. Yeah, I could do that. Inventory 8119, prepaid expenses. Sometimes they say other / other. Next company we'll look at the prepaid expenses, what that is, if you're curious, because that's a good goal, and that's my goal. Is I want to be able to explain everything if anybody ever asks, because it's good for me to know. Like, I can't tell you what the prepaid expenses are, this 1.3 billion, but I could tell you what. I can't tell you what it represents, that number, which expenses, but I could tell you what a prepaid expense is, and I have a good idea what it probably is, but I don't know exactly. Accounts payable, one, and this is also listed in a certain order. It's listed the debt that should be paid the fastest. It's listed in that order. So the debt that should be paid off the quickest, possibly over the next month or two. Most of these payables should be paid off, and then some of this debt won't be paid off for another year. Everything should be paid off within a year because that's the definition of current liabilities. But this should be paid off the soonest, then this, then this, then this. And if you go to non-current liabilities, some of that debt might be paid off in 2 years or 20 years, and it gets lower and lower. And this is in American financials. If you look at most non-US financials, it's the opposite. I think IFRS, but not all non-American companies. There's a lot of non-US companies, like some in South America, that have listed similar as the US companies, from most liquid to least liquid, but some do it the opposite. Like, why can't they just all do it the American way? Why can't everybody just speak English? Because that's just not how the world works. We're not the only country. We can't expect everybody to change for us. Even though it would be easier, but it would be, if you live in China, it would be easier if everybody spoke Chinese. But okay, payables to contract. So we might have to add accrued expenses, which is the same as accrued liabilities. 16,183 current. So let's add some payables to contractors, which is different than accounts payable. Contractors and equipment suppliers. 7151. Cash dividends. So these are dividends they owe their investors, people like you, but they haven't paid it yet. So it's just a timing thing. They'll pay it. Maybe it's a quarterly dividend. So they put it onto the balance sheet until it's actually paid. Because most things don't just sit on the balance sheet forever. They're on a balance sheet for a certain amount of time, sometimes a day, a week, a year, 100 years. Certain things are there forever. But what do I need a 16,183. I need the 230, current portion of bonds payable. So they owe money on the bonds because these may have been 20-year bonds, but but now they owe some of that money. Like they may have bought a bond 20 years ago, and now they have to pay off the last portion of it, or maybe just the interest portion of a bond that's due on a maybe quarterly or semi-yearly or annual basis. But it's the lowest, so it's probably due a year from now. Bonds payable. Okay, let's look at Broadcom, AVGO. Okay, so let's just search current assets. Anybody doing well with any particular stock? Meta has been doing really well for me. It finally came back to. I mean, I'm flat on. I got Meta at 150 in 2017, so I'm up over 100% on that. And I did buy a big chunk also at like 340, so I'm like down like 5% on that. Hey Ed, what's up? Carvana. Berkshire Hathaway is doing great for me. So in my retirement, actually, I have 4 investments. Like I switched out my investments in 2017. I still have the same 4 from 2017. It's BRK, Meta, PDP, which is like an ETF, which small cap, half of it is small cap, I think a quarter mid cap. So two of the 3, because Spider is up like 90% since 2017, I think, the last time I looked. So I'm happy with that. But fortunately, I'm beating it. I'm up like 110% in my BRK and up like 130% in my Meta. PDP is up like 70%. So I'm doing okay. But I even admit, I don't know if I'm beating the S&P 500. Historically in my life, I might be. It might be close, but it gets boring just putting in the S&P 500, not doing anything. It's fun to kind of like try to make a really big score. But anyways, Zoom is impending breakout. Yeah, possibly. It's a good company, Zoom. It's a tough industry. Let's see, Broadcom. Okay, cash, 12 billion. Okay, accounts receivable. Some companies call them trade receivables. Same thing, 2914. Inventory, 1842. And then other, 1522. Well, let's look at other. Let's go back to it and see what's I'm really hoping Appcelera. I put a lot of money into that. It's a risky one. I wouldn't like suggest it to anybody. And pets.com. No, PetMed Express. Those are my 2 risky investments. that I have like, 2% of my portfolio in, or maybe 3%, I don't know. Employee compensation and benefits. This is like employee compensation and benefits. That's an accrued liability. That's, if we searched accrued liabilities for these companies, a lot of it is probably employee compensation and benefits, because that's a really common accrued liability. It's just a timing thing. So if you pay out, say, 100 million in bonuses, like a company like Nvidia has a lot of employees, the CEO gets 10 million bonus, so that's like 10% of the bonus pool is CEO. But then you have the secretaries who get like $2,000, and then maybe a manager gets 7,000 or 10,000. So they pay out $100 million in bonuses every year end in December. So they have to put that on their balance sheet so investors know. And then once they actually pay the bonuses, they remove it. But that's just one thing. There's also timing of other things, paychecks. Like if a paycheck is, they're going to pay employees on the first of the month, they have to carry it on the balance sheet. Say we look at the balance sheet on the 31st, it should be on there on the balance sheet. And when they actually pay the employees on the first, they remove it and put it onto the income statement as an expense. Current portion of long-term debt, which I guess, which is same as short-term debt. It's the current portion of long-term debt. Because at some point, long-term debt is long-term. Like you owe it 5 years from now. But after 4.5 years, it's going to be short-term debt. So it's the current portion of the long-term debt. Other accrued, where do we put other? I guess I'll just make an other bucket. That's like a lot of, look at that other. That's like 65% of their Mercado Libre, Latin America e-commerce. I think did I do a video on that? It sounds familiar. So this is a red flag. I mean, Broadcom is a pretty good company, but I wouldn't be questioning their ethics. But if with other companies, I might be like, whoa, what is that? That's a big number, 4.4 billion, and that's most of their current liabilities, and it's under other, so we have no information. So let's just look at it. Okay, so they define it here. Contract liabilities, which is a bulk of it, 2.9 billion. Let's see if they define the contract liabilities. And this is like you get in these rabbit holes, but this is how you really learn this stuff. And if they don't define it, you can just Google it. It's changes in our contract assets and contract liabilities. It's a timing difference between our performance and the customer's payment. So they have a contract, so maybe they have to deliver. Let me see what I wrote down, because it'll make it easy for me to explain. Contract liability. Contract is recognized when a customer prepays consideration or owes prepayment to an entity according to the terms of contract. Contract is recognized when an entity is satisfied. So it's just timing. So if you say you sold chairs, you might have a customer, say a retail store, that order 100 chairs, but you can't really make 100 right away. It takes time for you to manufacture. So maybe over the next 10 months, you deliver 10 chairs, and the contract the liability reduces each time you deliver it and they pay. I mean, it's all the same concept. It's all it's kind of like accounts payable. It's you sell something and somebody owes you money, but it is debt that you owe. It's just categorized a little bit differently. And tax liabilities, it's not like you past due on your taxes, but it is a timing thing. If you have a business and let's say you have to pay, I mean, if you have a business, you probably know this. If you don't, you might not know this, but you should be paying taxes somewhat often, not just once a year like most people do. If you have a business, you probably have to pay it quarterly. So, and your accountant would tell you before the year starts, based on last year's revenue, you should be paying $20,000 each quarter to the IRS. And of course, if you have a lot more revenue, a lot less revenue, it could get adjusted. But based on last year's revenue, you should be paying $20,000 per quarter to the IRS. So you just have to, write a check out to the IRS each quarter for $20,000. But before you write the check out, you have to show it on your balance sheet so investors know. Then when you actually send the check into the IRS, then you take this off your balance sheet. So it's money that you will owe, but it's not due yet. It may be due at the end of the quarter, or maybe the end of the next quarter, or maybe the end of the year, but it's definitely due within 12 months. Interest payable. So if they have debt and they have to pay the interest to the debt holders. So if somebody bought a bond from this company, they may pay quarterly interest. And this is the interest that's due within the next 12 months. So it might be $100 each quarter for the next 4 quarters. And the debt that's due next year, and the interest and the principal that's due in 5 years on the debt, that's in the other or long-term liabilities. It might be in other, or they might break it out. We'll go to the balance sheet to see that. So they usually use other for insignificant items that on their own don't make up that much. But in this case, it's pretty big. But as long as they define it, I mean, that's all you really need. And you're probably not going to get, like, in theory, this information has been scrutinized by analysts already. So they took this into account when buying and selling the stock. So the market the efficient market hypothesis. Everybody has all the information. So the market is working perfectly at all times. It's not quite at that point, but it's pretty fluid, the market. But if you can like identify these things, it is possible you can identify something before the market does. But I think it's a lot of luck too. Like when you see this stuff, like you just have to have a hunch. Like sometimes you guess something and you guess wrong, but you'll make a lot of money. Or you guess right and you lose a lot of money. So timing is a big thing. So all these companies already have above 2, which is, I think, a current ratio above 1.5 is fine. We might, if we get to a smaller company, we possibly might see some different scenarios. Let's look at AMD, Advanced Micro Devices. Kava, new Chipotle. PDI, PIMCO, dynamic income, seems monthly dividends, seems high volume, recent months. Let's look at current liabilities. I'm working on my Suncor video. AMD, okay, 3561 of cash. Investments 2224. Accounts receivables. You know why it says net? Because that's not how much is owed to them. That's what's owed to them after subtracting what they expect not to receive. Because they probably have, like, of the 5 billion, like, say, it might have been like 5.1 billion. And then they say, okay, based on historical figures, 2%, I don't know. I mean, it's not going to be 5054, but okay. So just to give you an example, like, they might have 5.1 billion that's owed to them from when they sold product, but they most companies won't put how much is owed to them. They have to subtract what they expect not to receive. So if they say historically 0.9% of our receivables we don't get, the customer may renegotiate and give us a hard time. The customer may go to business and we can't get money from them, or the customer, the product is problematic. They have issues with the product, so they want to return it, or maybe we give them a discount, or maybe they just offer discounts. They, like, to certain customers, if they pay within 30 days, they give them a 1% discount. So they say, okay, of the 5.1 billion, 46 million probably we won't get for whatever reason. So they have to put the net, what they expect to get, not what. So that's 5.054 billion. That's why it says net. And there's also what's it called? They might have it listed on the balance sheet what they. No, they probably don't list it. It would be here. It's called allowance for doubtful accounts. What they expect not to receive from the accounts receivable. Allowance for doubtful accounts. I guess we can. Allowance for credit losses. Tenant allowance. Yeah, I don't think they list it. It's usually not too significant. But like doing these exercises kind of clues you into other things, and it gives you more kind of information. Prepaid expenses and other. Let's see what that is. That's a prepaid supply agreements. So relate to short-term portion of payments made to vendors. Because if you if you ordered 100 items and that cost $100,000, and and your supplier said, well, you have to give like a down payment because it's expensive to make $100,000 of product, and I want to make sure you're going to pay me when I finish making it. So they asked for $20,000 up front. So that's carried in the balance sheet as a prepaid expense. That's an asset because you paid it already, but you didn't actually get any product yet. So you can't put the inventory on your balance sheet until you actually get the product in the door. So you just carry it as a prepaid expense. And then so your cash goes down. So say you had to give a $20,000 deposit. Your cash decreases $20,000 and the prepaid expenses goes up $20,000. And then when the order is complete, your supplier says, okay, now you owe me $80,000. I'm going to ship out the product, so make sure you send me the $80,000. So your cash goes down $80,000. Your prepaid expenses goes down $20,000, and then you put the entire $100,000 on inventory. So that's how you reflect everything appropriately in the balance sheet. So when you actually spend money, when money goes out the door, you have to book the asset. But when you receive money from a customer, you don't put it as an asset, you put it as a liability until you complete the order, which sounds weird. So if a customer pays you, so if it was the exact opposite, you are supplying the product to the customer and your customer ordered $100,000 and you asked for a $20,000 upfront payment, you will put it as a liability. Your cash goes up $20,000 and your liabilities goes up $20,000. Unearned revenue, it's called. So you get money, but you have a liability, which sounds odd. Like, why would you have a liability? You don't owe money to anybody. You don't owe money, you owe a product. So when you finish making the product and you ship it to the customer, now they have to pay you $80,000, right? Because they already paid you 20 and the entire order is 100. So now they pay you 80. So once you get that cash, your cash goes up $80,000, but you remove the liability off your balance sheet. You remove that $20,000 liability and you book the entire $100,000 onto your income statement as revenue because you made the sale. So it's always the opposite. When you receive cash, like when you receive a prepayment, you book a liability. When you send a prepayment, you book an asset. So when you send money out the door, you book an asset. It's just accounting until the order is complete, and then you can do an appropriate box. AMD. AMD. Accounts payable 2245. Let's see if they define that. Okay, well, let's just keep going. Payables to related parties. Like I put down on payables contractors, I guess. Accrued liabilities 3376. This is probably like payroll and other things. Current portion of long-term debt, short-term debt. Other 929. 7627. So they're 2.2. So everybody's pretty. Let's see if we can do Intel quickly. Actually, I put the wrong ticker on there. Not that it matters. Come on. Current asset. So if a company has a current ratio above 1, you can feel pretty safe they're going to be in business by next year because they have enough funds to cover their short-term debt. Even if it's not above 1, they probably will be in business, but it's pretty. You could be pretty confident if it's above 1, they will be in business. Other 4472. But when you kind of put all these things together, current ratio, then long-term debt, cash flow, everything, it paints the entire picture. Short-term debt. So this is on top. So maybe this is due soon, within a month or within a week. Usually accounts payable is on top, but maybe most of their accounts payable is due in 2 months. Accrued compensation. I guess I could just put this with accrued. Probably the same thing. Accrued compensation. Income taxes payable. I didn't have a. I guess most of these companies have income taxes payable part of other. So if we wanted to, we could split out the other, especially when a company gives that info, and if they tell you how much income tax is payable, then we can compare that to other companies. And then other accrued liabilities, 12,430. So Intel has the worst current ratio. So if a company has a really high current ratio, like a 7 or an 8, that doesn't mean, oh my God, this is the best company in the world. They're just sitting on lots of cash. It's not like you can't think of a company as a person, because people generally who have a lot of cash are probably doing well, probably. And people who don't have any cash in the bank are probably struggling, living paycheck to paycheck. But a person is different than a business. A business is not supposed to just sit on cash. If Apple wanted to, it could have $1 trillion in cash if they wanted to. But they're a business. Then they're not meant to sit on cash. They're meant to receive cash and then deploy it by coming up with new products, by manufacturing phones, buying back stock, doing something with the cash to grow the business and make it bigger. That's how businesses work. So you want to have a good current ratio, at least a 1.5. But you don't need to have a ton of cash at all times. But some companies like Berkshire Hathaway do have a lot of cash, like maybe 300 billion of cash. They have something like that because they are waiting for the right company to acquire, and there's a reason for that. But some investors get upset if companies have a lot of cash. They're like, I'm not giving you money just so you could put in the bank. I want you to give me a 30% ROA. So this gives us a good idea of how liquid these companies are. If you were looking at these 5 companies, And in this case, these companies aren't too much of a risk, but if there were 5 companies that were smaller, it would maybe give you a better sense of who is maybe in bad shape. But you can see, if you want it to be real stringent, you could say, well, if I just looked at the top 2 numbers, is that enough to cover the current liabilities? Nvidia, they have more than enough in the top 2. And you could even do a formula. You can just do cash plus marketable securities over, and if this is above 1, then they're in really good shape. And this is above 1, 1.6. This is below 1, and that's of course below 1. So AMD don't have enough cash to cover their short term. They have to wait for their customers to pay them, because they have $5 billion their customers owe them. So they need some of that to cover the shortfall, or they need to convert the inventory into a sale and then get paid for that sale. And prepaid expenses, I wouldn't consider cash at all. It is an asset, but it's not really going to result in cash. You're just prepaid something. You just owe less on something. But then you could, and if you wanted to look at a different view, you can say, well, I mean, some of the stuff may not be owed for like another 9 months. So you may only focus on the top 2 lines here and say, well, I don't care about what's a good color? Well, I don't care about these bottom numbers so much. I just want to make sure they can cover their payables and accrued liabilities. And if you look at, and for Intel, it's 12 billion. These 2. And they do have much more than 12 billion in cash and marketable securities. So you can say, okay, the 12 billion is in other, which I don't care about too much. Maybe you want to look what other is. So it just gives you a good view. And this is, and if you have your own company, a lot of people have their own company, don't know how to look at things. They just look at their bank account. If the bank account went up, they're doing better. If the bank account went down, they're not doing. But there's a lot more than that. Just because you make money doesn't mean you're doing well. Maybe you could have made a lot more money. And just because you lose money doesn't mean you're doing poorly, because you may have, most people would have lost a lot more than you lost, and you made some good decisions, and you're getting to that break-even point. Hey, Victor, what's up? Yeah, I got to have you on these live streams. Like I say, it's kind of a last-minute thing if I'm in the mood to do it. But Victor has a channel too, so go check out his channel. AV, you have Broadcom, bullish on Broadcom? Yeah. They're all good companies. Semiconductor, we kind of missed the big run up. I mean, these stocks have gone up a lot. Nvidia is like 10,000%. I mean, so we missed the big run up, but I don't think it's kind of like saying, oh, I didn't buy a house. I was going to buy a house in 2018 and I didn't. I missed all those gains. So therefore, I'm never buying a house. Like, it's still thank you, Victor. Appreciate it. Really nice of you. So yeah, sure. I mean, timing is important, but more important is just the time you're in it. I mean, if you time it in the very worst time, unfortunately, you might never make a profit. But chances are, if you have 10, 20 years to wait out, I mean, if you buy a home, you might not need to sell it for 20 years. Yeah, a nice run up from Broadcom. That's great. Yeah. I haven't been selling that much. I have I sold some stuff to buy Netflix a few years back, and I'm up pretty well on that. But I always get hesitant to sell things. I'm always like, I bought it for a reason, but so I actually have a call soon. So but I hope this was helpful or interesting, a little different than my usual videos or live streams. And this could be a topic I could do, like the price to book of 5 companies in a certain industry. I mean, certain stocks are overbought. It's never going to be the entire market is overbought. Maybe on average, the average company is overbought. Maybe so. I'm not saying it is, but there's always deals. There's always discounts. If you have, it's really if you have the money and the patience. Problem is, most people just won't wait. They sell too fast, or they buy. But it's hard to sit on something. I remember when my Meta, that's a good example. And people who bought Meta was like, oh, I can't believe I listened to you. And I was like, yeah, I know. I'm down a lot. I'm down 60%. And I put in probably a lot more money than you put in. But it's back. It's back up. But a lot of stocks I say I like, and they never come back. They just keep going down. So nobody bats 1,000. I know Apple's always priced too high, but it's gone up so much. I wish I just bought more of it. It kills me. It seems so easy. So now it's like so obvious. When it was $1 trillion, you could have tripled your money, but it's over 3 trillion now. But it was, oh my God, $1 trillion, and way too high. Who knows? I'm still learning too. Well, I got to go. I have this call soon. So thanks for joining. Leave a comment. Let me know what you thought of the video, and I'll talk to you soon.